The hidden trap of IUL. Indexed universal life insurance, often called IUL, marketed as the ultimate financial tool. Agents claim it offers stock market gains with zero risk, tax-free income, and lifelong protection. Sounds perfect, right? But here's the uncomfortable truth for many people. IUL can be one of the worst investments they ever buy. That might sound shocking because the sales pitch is incredibly convincing. You'll hear phrases like market upside without downside, tax-free retirement income, and build wealth safely. It sounds like a dream combination of investment and insurance. However, once you look inside the policy, things start to look very different. Hidden fees, performance caps, complex rules, and long lock-in periods that can trap your money for years. Many buyers only realize these problems after paying thousands of dollars into the policy. In this video, we'll break down exactly why IUL can be a bad investment, who it actually benefits, and what smarter investors do instead. If you are thinking about buying an IUL or already have one, you'll want to watch this video carefully, because understanding this could save you tens of thousands of dollars. Before we talk about why IUL can be a bad investment, let's quickly understand what it actually is. Indexed universal life insurance is a type of permanent life insurance policy. That means it provides a death benefit while also building something called cash value. This cash value is linked to a stock market index, often the S&P 500. But and this is critical, you are not actually investing in the market. Instead, the insurance company credits interest based on the index performance while applying two important limits, a floor and a cap. The floor protects you from losses, usually around 0%, but the cap limits how much you can earn, often around 8% to 12%. So if the market grows 20%, you might still only receive 10% or less. At first glance, this seems fair, no losses and decent gains. But the reality becomes more complicated when you add fees, insurance costs, and policy charges, which can significantly reduce your returns. And that's where many investors begin to realize this product behaves very differently from what they expected. One of the biggest reasons IUL can be a bad investment is the fee structure. Unlike traditional investments such as index funds, IUL policies come with multiple layers of charges. First, there are premium loads fees taken immediately when you deposit money. Then you have administrative fees just for maintaining the policy. Next comes the cost of insurance, which increases as you get older. And finally, there are asset management charges tied to the policy's investment component. When all these fees stack together, they can significantly reduce your returns. For example, if the market performs well and the policy credits 10% interest, but your total costs equal 4% to 6%, your actual return may be much lower. In some early years, most of your premium doesn't even go into investment growth. Instead, it pays commissions and policy expenses. This is why many financial professionals warn that IUL policies can take 10 to 15 years just to break even. And for investors who want flexibility and transparency, that can be a serious problem. Another major drawback of IUL is the return cap. Insurance companies limit how much interest your policy can earn even if the market performs extremely well. For example, imagine the stock market rises 25% in a year. If your policy has a 10% cap, that's the most you'll receive. The remaining 15%, you don't get it. Over time, this cap can dramatically reduce long-term growth. Historically, the stock market has produced strong returns over decades. But when those returns are repeatedly cut by caps, the compounding effect becomes much smaller. It's like running a marathon but being forced to stop every few miles. Yes, you avoid market losses due to the floor, but the trade-off is that your upside potential is significantly limited. For long-term investors, that limitation can mean hundreds of thousands of dollars less in retirement savings. This is why many experts suggest that investors looking for growth may achieve better results using simple index funds instead of capped insurance products. Another reason many investors struggle with IUL policies is their complexity. Unlike simple investments like ETFs or mutual funds, IUL contracts can be hundreds of pages long. They include terms like participation rates, caps, spreads, surrender charges, cost of insurance adjustments, and loan provisions. For the average investor, understanding all these moving parts can be extremely difficult. And when financial products are complicated, it becomes easier for misunderstandings or overly optimistic sales pitches to occur. Many buyers believe they're getting stock market, like returns with no risk. But what they're actually getting is a complex insurance contract with many variables that can change over time. Insurance companies can adjust caps, participation rates, and policy costs depending on market conditions. That means the performance you were shown during the sales presentation may not be what you experience later. Transparency is one of the most important principles in investing, and unfortunately, IUL policies often lack the simplicity that many investors need to make confident financial decisions. So if IUL policies are so complicated and expensive, why are they sold so aggressively? The answer often comes down to commissions. Insurance agents can earn large upfront commissions from selling these policies, sometimes thousands of dollars depending on the premium size. That doesn't mean every advisor has bad intentions. Many truly believe in the product, but incentives matter. When a financial product pays significantly higher commissions than alternatives, it naturally becomes more attractive for salespeople to promote. Meanwhile, simpler investment options, like low-cost index funds, often pay little or no commission at all. This creates a conflict that investors should always be aware of. The goal of investing should be long-term growth, transparency, and flexibility. But when products are driven by sales incentives instead of investor needs, the results may not always align with your financial goals. That's why the smartest investors always ask one simple question before buying any financial product. Who benefits the most from this? The answer can reveal a lot. So, is indexed universal life always a bad investment? Not necessarily. For certain high-income individuals with specific tax planning strategies, it can serve a purpose inside a broader financial plan. But for the average investor, the combination of high fees, capped returns, complexity, and long lock-in periods can make IUL far less attractive than simpler investment strategies. In many cases, separating insurance and investing can be a much clearer approach. For example, using affordable term life insurance for protection, while investing in diversified assets like index funds for long-term growth. The key is understanding exactly what you are buying before committing your money. Financial decisions should be based on education, not sales pressure. And hopefully this video helped you better understand the realities behind IUL policies. If you found this explanation helpful, make sure to subscribe to the channel for more honest breakdowns about investing, personal finance, and financial traps to avoid. And I'd love to hear your thoughts. Have you ever been offered an IUL policy, or do you currently own one? Leave a comment below and share your experience. Your story might help someone else make a smarter financial decision.